Okay, welcome everyone. Happy Monday. Welcome back with Dan today. So this week is going to be a very interesting week. We have some really big earnings coming up. We have Nvidia, we have Salesforce, and others. So today we're going to go over some of our data sets and how you can look at it to prepare for earnings. We're going to focus mostly on Nvidia, but we're also going to look at other stuff. So welcome, Dan. Thank you for being here.
Hello, Fabio. Very happy to be here. Hope it's not too loud. I had to switch places last minute, so
No
give
worries.
us a sign if you can't hear well. But very happy to be here in this exciting week with this kind of earnings, and gonna look at some things you can tweak and do with the data MenthorQ provides.
Awesome. Yeah, so we're also going to have a big product release at the end of the week, so stay tuned for that. But I think for now we're gonna be focused on the data that is available, but there's going to be new stuff coming over the next couple of weeks. So stay tuned there, guys.
Okay, wonderful. So let's dive in. As we said, we have Nvidia coming up. That's It used to be the highlight of the earnings season, but maybe one or two words why we talk so much about earnings here, why this is important for retail traders, even pros, because it's one of the few resources where in places where you can do good trades using volatility, which the big institutions they can't trade. They do trade it, but they can't trade it the way we can, and we can use this in order to try to trade and get an edge. And we have seen that. I won't dive into special data and other stuff. If someone needs that, please pinpoint me in the MenthorQ Discord, and I will try to elaborate. But that's why we focus so much on earnings, and we can do amazing trades with that. It's different than OGT or future trades. It's totally different because if you have a earnings trade, and if you have never done an earnings trade, it's like you go to a magical place where anything can happen in a good and a bad way, and then everyone is poised. And this week, Nvidia is it's like Christmas for everyone this week, because if Nvidia does well, we'll drag up maybe the Nasdaq, and the QQQ should go up, and the spiders, and that's why it's important to have Nvidia on the radar. And yes, most of the earnings which happened, Nvidia did very well. It skyrocketed, but not all the earnings. So it's good to know the data. It's good to know your risk. And the easiest way would be just selling put. To think you have a bullish bias, so maybe just buy, make it false. And you know my opinion on that. And that's why I would like to pinpoint you to something which we don't show that often, and that we will see more and more used, especially when you get the new dashboard, which I'm very excited will come very soon, and I can't wait to see it. So if we take a look here, today NVIDIA is up nearly 3%, but this is okay. This is this timestamp we see is from Friday, which gives a very good view what happened here. Yes, Friday, everything and everyone did. And the thing is, I want to pinpoint you to something else. You see here suddenly there's a put bias. So this means that there is, and Fabio told me this before, and I had seen that also. It's like you see that players and institutions are hedging more. This means that they're afraid if NVIDIA doesn't deliver the high expectancies, or in the end it delivers, but not as expected by the market, and the algos try to start to sell off, there is some hedging done. So the question is, how do we use that? Yes, we don't use that by just dipping in and saying, yeah, NVIDIA is in a bearish territory. We go by data and just decide according to the data what would be a good risk reward strategy for this stock. So how would we do that? First thing is the easy way, the most easy way, like we have done, and I've shown, tried to show in many posts, and I will talk about that after we talk about NVIDIA and Salesforce, and I will explain why I do not take all the earnings which are available on a certain day, plus that the model delivers a result. I don't take them all. And there are some very simple answers which I can answer to you. And but let's focus on NVIDIA. NVIDIA is a highly liquid stock, which makes it easy to choose it. Even in the last hours, you should get some good risk return. And if earnings were today, what would we do? You have two approaches. I will make it a bit bigger so everyone can see it. We have the lower band here. This is the history, and we focus here on the lower band. And the lower band, what does it give us? The lower band gives us basically an idea what we could do. I've shown in other sessions that the most easy thing would be to choose the lower band as your break-even point. And just build, either sell a put there, which is risky, or maybe sell a spread, a vertical spread, and get some credit. Because what happens, I don't know if you are familiar with IV Rush and IV Crush. It's very simple. We've talked about that very many times. Very simple. Before earnings, there's a lot of uncertainty. What does that lead? That leads that due to uncertainty, volatility rises more normally than the historical volatility. And this inflates the prices of options. Right after the earning event has happened, the price will swing around, but volatility will deflate. This means that the premiums, which have been very high for the market participants, which hold very long time portfolios or take huge bets, and we saw this in the put buyers now, the prices will just deflate by that. This means if you are a credit seller, your short leg will immediately just lose a lot of value, which is good for you. And if you have chosen a long leg as a protection in the same circle, it will also deflate, but in the end, it gives you some protection for the price move. I will talk about calendars and other stuff I've been showing in the Discord, and why I do that, and why this could be a good idea, and how to choose and play volatility right, because in the end, it's all about volatility. But we want to keep it simple. We want to make it available to you. Maybe you don't trade, you haven't been trading for that long. So a good and easy approach could be, yes, you can have a full loss. This can happen, but if you choose your risk return, nothing bad happens. You should never trade more than 2% of your buying power in a single trade. But if you feel you have an edge, if you have traded 1,000, 2,000 earnings, and you see the statistics have proven the statistic MenthorQ has shown you have proven themselves over a long time, then yes, trade 4 to 6% of your account. But please, in the beginning, focus on the 2%. So the easiest thing would be we build something here around the 123. Something else which I have been experimenting, but I have not collected enough data, would be, let's say earnings were today after market close. The first thing I would do is, like 2 hours before market close, I would like to see how much the stock has moved. If the stock has moved 2 or 3% like it does today and it stays there, then I would add that a bit higher, because if you had a timestamp for tomorrow, the lower band would be higher. What does that bring? Sometimes this is necessary in order to get a good risk return. Yes, if you have a downward move, then you might lose. Whereas if you stick with what we see today, which is a bit an older data, you are more safe if you have a bias. This is up to you. I would always do that if I see my risk return is more than 5, or I can't get around 3 to 5, then I might think about that if I really, really want to take this trade and I really feel comfortable in doing so. How else could you construct this trade? Another way to construct this trade would be to say, yes, I believe there's a bias, but I believe we will stay in some range, because NVIDIA, yes, it might explode, but expectations are there, so it will bounce around for the rest of the week, because the trade doesn't end on Wednesday. If you take a trade with weekly options, it expires this Friday, and this is something which you should do if you sell credit. You don't want to go too much out in earning trades. In other trades, it's different. And we'll talk about this another time, but with earnings trades, you should stick close. With selling premium, you should stick close to the date, because you want to take all this Ivy crush with you. Another thing would be we construct an iron condor. What will happen? Most probably, if NVIDIA has good earnings, the iron condor will be breached on the upper side. If the earnings are not that good, it will be breached on the lower side. So yes, you have more chances, but most probably, if NVIDIA is such a high stock and the expectations are so big, either we go to the moon or we fall into the pit of Tartarus. So this would be a stock, one of the few stocks I wouldn't go with, basically with a non-directional trade. I looked at a lot of data for today, and I looked at 10-year data, 2-year data, 5-year data, and I always feel the stocks are evolving very fast, so we can't take the data so much time out. So basically, the average move of NVIDIA is about 10%. It's about 10%. And we've seen a lot of heavy action on the put and on the call side. So if you build something, you should feel comfortable with a move of 10%. Yes, we could build an higher condor 10% wide, but most probably the risk is there that we break it on one or the other side. So let's go into practice and see what we saw here and try to see if we can adjust this break-even point. So we have a very simple, easy trade. I will show you, I will take more trades on NVIDIA and try to share them all so you can, in the end, have an idea. But what we do here is just trying to tell you how to use the data. I will just set up this very simple trade, and then we'll see, can we improve this trade with all the data we have from MenthorQ? And yes, we can, because the model is a simple approach. And for other more advanced users, or for the ones who want to try to squeeze things, try to harvest more of what the data offers, we can use the data and make something else out of it. So I'm going to switch my tabs very fast. So if we see NVIDIA, so I said about 10% is the expectation here. It has already moved here to 11. So this means somewhere around we can expect it will go to the one or to the other side. Let's see if we have a very bullish bias. We would use this here, but we have a normal bullish bias. And let's build this trade where we have a break-even point at 133. 23, something here. So I shared some Excel some time ago, and I will repost it again, which is an Excel which is very nice because it gives you a good idea how far the strikes could and should be. Sometimes the 123 will offer less protection than the 124. So you see the risk return here is 1 to 5, which is okay for a stock like NVIDIA. If you put a higher limit order, maybe you get 25 for it, which is also bearable. It's a bit higher than the 5. As you see, most probably, and we are 2 days away, we have an inflation of the prices. So if you took it today, then you get 1 to 5. But if you wait 2 more days and the prices go up, most probably you get a bit more. So I always take my earnings trades not in the last hour, but somewhere around the last 1 or 2 hours, if possible, and try to get as close to the actual price in the end as possible. That will be a very, very easy trade to take here. But there is something, like I said, we feel comfortable because NVIDIA moved today. Let's say, again, today would be the earnings day. We see NVIDIA moving up today. Now we see her 1%. So this makes it easy. We could go a bit closer here because we say the model tomorrow will give us other data. So what I would do here is just take the model, take the 123, add 1%, which is about $13. And then it would move, not $13, it's $1 and 2.315. Very sorry for that. So we would move to 124 as a break even here. So we take the 125. So already you see, make more credit. And this is what the model would show us tomorrow. And we still feel comfortable because the market has moved up. So also has moved other factors of the model, and the model would give this to us tomorrow. yes, we're closer. The break even is closer. It's 7.9. The other one was 8.6. And if we take the average move, we want 10%, only $17 and a margin 100. Would I take this trade? No, probably not. I wouldn't feel comfortable because even if we stay in range and most probably have all the data on our side, we could drop and my risk return is really terrible. I would lose more than I would make on other trades. It's always something we should bear in mind. So let's move back to MenthorQ and take a look at the levels we have and other stuff which is important to us. I'm a big fan of the option metrics. And I know a lot of you use that. So what does the metrics show us? We see a lot of green, which gives us confidence. And we don't need to look out here. This is far away. Yes, we know there are positions and everything, but this is something which we feel comfortable here. So we look at this Friday. We have an expected move of 11. What I showed you is the straddle price. So this is 11. So the put support is at 115. So you could come and say, okay, 115, why don't we just put up a trade there? Yes, you could do that. And most probably it would be okay. But in the end, the risk return isn't that good. So what do I like to do? I like to take a look at the other levels here and see if there is some confirmation and what I saw. And now we come back to what we started off with Fabio showing you in this queue. If you look here at all these levels, you see it's 120, 105. Oh yeah, there's 125, but all the other ones are lower. Does this change something for our trade? Yes, it does. Because basically it shows us that, yes, the model gives us this break even, but the market has become more cautious. So the market isn't that wrong most of the time. So this could change this trade and tell us we should go lower or just don't trade it, because in the end, if the risk return we get isn't that good, then we should just stick to the plan. We just trade the things which we feel comfortable. That's the thing. So another thing is you can look at other levels and other things which have moved lately. You can take a look at volume and open interest, which is really, really interesting. It's basically, it shows us the same thing and gives us a confirmation that, yes, we see here some puts coming in and that this queue in the end should be closing. So what I want to say with all of that, let's move to the main charts for a second. The thing is that in the end, you have a trade which most probably will work off well because NVIDIA has most of the times outperformed and we saw it go up, but we saw some big dips in the last couple of times. So this would be a trade I would trade. I mean, I wouldn't hesitate trading with a 5 day model, but I wouldn't go in big because I see some you on the downside and you should be more cautious there. And if we look at the general data from NVIDIA, which is like it has beaten the implied move in the last 2 years 3 out of 7 times. What does that mean? What does that give us? This means that this is a stock which stays in the 11% range or 10% expected move. So if we take a trade and want to be super safe, we take it out of that range. Why wouldn't I take it? Because I don't like a risk return higher than 5. I don't want to make $17 and risking $87 plus commissions and slippage and everything. So this is my personal approach, and I will talk about which trades I take and why I choose trades and which trades are safe and which are not safe. So I think it's a good time to move on to the next highlights. If you don't have any questions on that, Fabio, which is Salesforce, which should also be a biggie this week. So I don't see any questions right now, Fabio.
Yeah, no questions so far, Dan.
All right. You may and shoot us questions anytime, and very happy to answer that. So I know a lot of people are psyched, and I know a lot of people are love to just buy a lot of calls and Sometimes they get lucky and then they have a big stake, but in the end, the MenthorQ offers is great data to try to give you an edge where there is no edge or enhance your edge. And in the end, you may win once and you may go to the moon once, but in the end, no one, I don't know anyone in the long run, or maybe very, very few informed people who have done well by just playing lotto. And there's nothing else in playing lotto in my eyes. So if the data doesn't show you like, yes, we're poised to go to the moon, then we won't go to the moon. Most probably we're going to land up somewhere in between where this is, and there's nothing in between, just blank space. So if we have Salesforce here, let's start with the same analysis and take another look. And let's take a look at some other statistics later. So Jan has been loading up. Let's make it bigger. So we saw here hitting the lower band, which is like, okay, I have talked about the lower band and what I do in this kind of times. Like the lower band because I like, and I think always it's somehow a point of reversal, a point of going up again. So the lower band is 291. Today we're seeing Salesforce also dipping a bit. So this means most probably in a normal trading week where we wouldn't have earnings, that either we have a permanent shift in the band or most probably a bounce above the band again. So this is something you can generally take with you. If you are lucky to see a lower or upper band being breached, take a close look at the put support or the call resistance, or maybe get yourself ready for a nice bounce where we squeeze up. Here, what does this show us? We're still in a very bullish territory if we have a lower band. And the chances are that we are poised for, in the end, a more bullish bias. They are. In the end, when we did, yes, we can definitely look at statistics later, but if you buy here close to the lower band, what will happen? You will get a great risk return for that. Yes, the risk might be higher because you're closer to at the money, but you have a higher risk return than you would have with NVIDIA because the lower band is closer to the money. Let's take a look at how we could play this. 291. So we have a dive of here. So this is a credit of 90 or a margin of 225. In ways of risk return, this looks way better than NVIDIA. Yes, in the end, can we break down there? Yes, but now I will show you something which I've shown a lot of times. What happens if we have earnings? And a lot of people might know this. A lot of people might have missed that because a lot of these brokers and others they don't calculate it properly. So the thing is, you can go to the next expiration, for example, here, or one of the following expiration and see how much we will dive. What do I mean as dive? The implied volatility is around 100. And it should cut itself by one third roughly. So most probably if we stay in that price range here, 304 to 310 or around 300, and buy our spread because price is rise, normally we can make a bit more if we wait and don't open the spread because we have still a lot of hours till the earnings event. We would get more than the 90, roughly about 100, which is very nice. And what happens if volatility drops? And that's another thing. A lot of people who play the IV crash, yes, think the market opens and the short lags, the volatility, if it isn't hit, drops like into nothingness. This isn't true. Not all stocks move the same, and it takes some time. But in the end, if you are on the safe side, the stock has moved. You have a bias trade like this one here to the upside. The stock moves nicely to the upside. Then you can leave your trade on. If this is not the case and the stock moves closer to you, you can wait a bit for volatility to drop more, but get out with 10, 5, 20%, trade a cut or get break even at least. Sometimes, even if your strike is hit, you can wait a bit because your stock the stock as it moves around a bit and doesn't go far beyond your short leg, then this IV crush and the expiration on Friday helps you. So let's cut this down to 70. What does this do? It gives us the break-even point is the same, but what happens? We're getting faster there. So if we stay inbound here, if we stay here inbound, it's really nice that we, even with a small move, we can make about 20, 30, 40, 50%. And this is another thing. Yes, if we are right on the side and we have played a non-directional trade, that's okay. If we stay in range, we keep our money and we'll close this trade very fast. If we have a trade like this, which has a bias to the upside, for example, then we are legitimate. We can keep this trade if we see that the stock has gone to the other side and let it go worthless. But I would advise most cases with this very simple strategy, and in the end is the ones who risk a lot in the end, they always lose. It's a factor. They always lose. They size too big. So it's better to make every week on these trades an average of 20 to 40% than make 100, and then lose a couple of times. Because in the end, what did we show with the model? We showed that the model in 7 to 8 times of heading this up produces winner. And we said we try to get 1 to 3. If we have only trades 1 to 5, like I showed with NVIDIA, let's say we make $50 on a trade, and the loss can be 200 out of a gap of 2.5, 5 points. Strike. If we take this and calculate it, yes, on the long run we can make money if we stay in the range. But do we get 100% of wins all the time? No. But it's better to reduce and make the gap of losses smaller by taking up these trades early. So this is a nice trade. And if you say, okay, this is a trade which gives me a nice risk return, but too close. It started moving down, it's too close. Maybe the model will switch. Yes, give the model time. If it switches tomorrow to a bearish bias, then we're gonna sell calls on the upper side. We don't follow everything blindly, but we try to make sense of what we see, and the model has performed great and want to keep it simple for you guys. And yes, we can't win all the trades, but we win most of the trades. So if you feel uncomfortable by this, you can go a bit lower and still get a very nice trade here. But do we trade this? No, we don't trade this because it's very low volume. This is something also I want to point to. You can see this just not by opening this calculator, but you can just look at your options chain and see which volume is traded. And what kind of setups do I use? I only trade a setup if I see a couple of hundred volume there. And this is one of the magic points we shouldn't forget. Liquidity, liquidity, liquidity. If you have a bid and ask spread of 10, which is very regular, this happens, plus some fees, you're already 10 to 15% down. Let's say you get $100 for a trade, you have to take out $15 already, which are a sure loss, whatever you do. So this means you should be very cautious how big the gaps are. If we move here, yes, we have 160 roughly to 500. This is still a good and nice trade, which gives us some profitability. But we can also go further down and see if this still is good for us. This will also be 1 to 5 or 4.5 to 5, which is also very acceptable and gives us a nice ability to move 6% down. So if I take Salesforce and look at the statistic of the last year, we have an average move of 7% in the last 2 years. And this is something which is encouraging because we can harvest the rest of the data and just, let's say we want to have a break even around 7%. Move a bit further down. So this is something which historical data, MenthorQ data, and other things in historical data is very simple. You just ask ChatGPT, or you just look it up in your broker how they move, and you get an average, and then you can orientate yourself by this. Other things are sentiment and other stuff. We'll look at this and dark pools, which can be helpful, but let's focus on what we have in front of us, which are liable and variable data sources. So this would still be a trade which I would take, because in the end, you have a trade which is like away 7% on the downside and gives you a nice more than 1 to 5 risk return, which is really good, and your chances are very nicely, and you can most probably win it. So what else could we do? We can, and I showed this last time, and then gonna go through some of the trades of this week and gonna see what things we could play and set up and what not, and why we should enter some trades, why we should avoid some trade. So this is an iron condor. How will we set this up? Yes, one of the easiest ways would be for a non-trading day would be just to go to the metrics. So let me close this here. Close. Okay, this is the metrics. I had to scroll up. So what do we have here? So we see, first thing we see is we have a 355 and the put support here. So we're very close to the put support, and we broke the put support lately. But again, today, if I go back, I see we are above the put support again. So the put support is always helps us wing these things up, and that's why it's so nice in the morning. If you look at the put support and you see the pre-market bouncing off there, sometimes you take some very nice swings back. So you could make a very skewed one to the upside, as long as the model is still in the green. You would take a break-even point at 355 and the 300, and you would make a lot of money. Let's try to see this. So we had the 355 as the break-even point. So this is terrible. A wide break-even. So we try to see something which is here, and the 300 is here. So you see, we get a very big credit, and we still have here on the upside, we have, because, and what did we say? Why did we build it like that? We built it like that. Our model is green. It gave us the support around the 300 line. And in the end, we skew on the upper side. And we don't need to look at all the red, because we're going to cut out here 70. We're going to go to 70, 65, which is realistic. So if we stay in this 7 range to the upside, most probably we go to the upside very fast. We're made close to the 90 or $80, which is like 60-70%, and everything which is above 50 in the first hours, you're out. You just out and close the legs, which are not challenged. You can leave them on and close the legs which could be or are challenged, and in the end, you make some nice win, and you are in profit. If you feel uncomfortable with this, then you could build it a bit here. Let's see. We're going to take a look, like we said. About 10 points. If we feel we want to build it equally, roughly 7%. This is something we could do here. And yes, you see here, this is equally built here. So this is $110 for a max loss of 140, which is like, wow, it's amazing. It's super amazing, because in the end, if we stay in the range of 7% of the week, which is the average move, we're gonna make money. This is something you can trade. And what is the good feeling about that? The feeling is that you have a put support here, and you have a call support here, but most probably won't be reached. If you feel you want to just follow the model and follow the data, then you should do it as I set it up before. But this would be a very valuable, liable way to trade that and stay in line. But most probably, I would take the data to skew a bit and see how things look. So let's look 1 second to the skew here, and then let's take another swing at how we can trade earnings. When does it make sense to look at the things, and maybe which trades we should take, maybe which trades we shouldn't take. So this is a very nicely look at the skew and what happens. What do we see here? The same thing which happened to NVIDIA, but not that bad. We
I think
were
Dan,
down.
can I see your tab, Dan?
Oh, I'm very sorry. I think you can see it now.
Yeah.
Thanks, Fabio. And just take a look here. Yes, we had a down move here, and still we moved today, but you can see here, and that's why I like this so much here. You see that we have a put bias, but it's not that big, and most of the time was green here. This means that the market is still positioned here. So in the end, yes, the model is signaling us green. That means if you feel uncomfortable, build an iron condor. If you feel comfortable following the model and seeing the other data, then yes, either go a bit further out of the money and lower than the model showed you, or go close to where the model signals you. And in the end, if we take 10 trades, and NVIDIA and Salesforce are the two trades which are losers because they were a bit muddy, a bit mixed. Does that matter? No, we don't care, because the model was probably will give us 7 to 8 winners this week. And this is the great thing. You have losers and you have winners, but if you have an edge, you don't care. Mechanically, you put them on, you take them off, and this is the thing. So winners, you can, and this is something I wanted to talk to you about 2-3 minutes, and then we move to other stuff. Where you manage the winners. The winners are easy. If you have a bias, vertical spread, could be a put spread or a call spread, where you sell, not debit, where you sell and you have a move to the other side. So if you feel that the model was right, you are right. I said, if you've made a 50% within the first hours, or maybe the other day, if you have 2-3 days to go, yes, you can consider closing it. Because most probably you won't only trade one contract. You will trade it with, let's say you have $100,000 account or 1 million account, you will trade more contracts. So thing which I do, if I see a very clear sign and I'm very, very sure, still I will take off 1/3 of my position, no matter what. Just take winners home. You've seen this mean I did do this with the strangles and with other things I do. I take off if I have made 25 to 50%. And here, this is a bit easier. You will reach 50%, take it off, at least 1/3 of it. If the thing hasn't moved that much, it gets sticky at some point, and you see the levels, because the levels, from MenthorQ, and this is a nice thing. I always pull up a chart with MenthorQ levels there. I've prepared, let's say I had 3 or 4 earnings trades, and this is something what I do. I'll open my trading view. I will take the levels for the data I want to look at and the equities I want to look at. I will put them all into the indicator, and I will have my tabs open, and I will take a look at these levels and at the trade. So if I see that, let's say, let's take here Salesforce. Salesforce moves a bit, but not that much. It goes up a bit, stays in range, and I see, yes, there's a strong put support at 300. I will take off 1/3, but I'm very, very confident that this will hold. So I would keep some of the trades on. If I reach 75%, I will take off another 1/3 of these trades. And the rest I might leave go worthless or take them off 80, 90%. But we pay commissions, we pay slippage and all these things. So this is a good way to handle the things. What do we do with an iron condor? With an iron condor, if we see the stock doesn't move out of the range, then we can leave it on, let it go worthless. But again, I would take off 1/3 and do the same procedure over again. Because we have we got more credit, but we have risk on the upper and the lower side with the condor, even if it's stayed in range. If we haven't traded the call and the put support, or traded something else around it, then most probably the moment when the earnings come out and the market opens and this inflation stops happening, so we have deflation, the known IB crush, then I would wait a bit and see if the stock stays in the range of the 7% and then start closing the trades. So what do I do? Let's say if Salesforce, we build up this 7% iron condor and it moves around 3% on the day of earnings. It says, okay, what do I close in the beginning? I would close the side which might get challenged. So if we move 3% up, I would close the call side, most probably for a small loss, but I wouldn't care because I would leave the puts expire worthless, which in the end will give me the whole win. So let's say I got $100 and I have to pay, let's say, I don't know, I have to pay $30 for closing the calls. Yes, I know in the end, if I leave the puts, I will end up with a $70 win in my hands. This is something how you can manage these things which are winners. What do you do if your iron condor or just so vertical is breached? If it's breached beyond beyond saving, let's say you have played the 300 put line we see here in the sand and your stock drops to 280. What do? I would suggest if you see a chance that it might pull, you can leave this on, but there are two bad things which can happen. Early execution of the short leg, which is in the money, which is not nice. You suddenly find yourself with 100 stocks of Salesforce, which might be something you want to have because you got them at a discount. I don't know. I don't like these kind of things. And on the other hand, another thing which can happen, I wouldn't let these things go just worthless if they are, or there's a chance of being in the money. Because in the end, you never know when these things get executed or if the long leg gets executed properly. And in the end, you just end up with a stock and there's, even if it's partly in the money, that you are saved. So this is something if I see it's beyond saving and I don't see any flows that might help it or see some other bounce back, I would just trade it. It's a loss. Doesn't matter. You close it, you forget about it, and you learn from it. So in order to get the 70 to 80% win rate, we need to have losers. We should understand that. It's like with everything else in life. If we win, someone else has to lose. So sometimes we have to lose. So we just should have statistics and mathematics on our side. Now I'm going to come back to the other tab, Javier, to see if we have any comments. No, I don't see any comments. So the first thing is before we come here to a close is what kind of trades you should take on earnings and how to use MenthorQ data. There are a lot of earnings going on every day. The first thing is I would not take trades on illiquid stocks. So a stock which I would like to trade should be liquid. So at least have a bid and ask spread on the option on a buy or on a sell. To be spread should be at least or max 10 to 15% bid and ask. I wouldn't pay 20. This is terrible. So this means some of the stocks we can't play. Another thing is like, should we play stocks which have a lot of high volatility expectations and are also known to move around a lot? Yes, you can play these stocks. And these are stocks, for example, like Snow or Zoom or First Solar or Mara. Yes, these are stocks which have moved 30%, 20% last time. But what can happen? If you're on the wrong side of this trade, then most probably, even if you stayed in some range, you're going to get breached. So I would focus on this on the second level to find stocks, to see stocks, and this can be done very easily. And you can follow some trades I do or some suggestions and ideas. Basically, it's not a suggestion. Ideas I post is to just trade stocks with this kind of strategies. There are other advanced strategies where we can enhance this, or we can trade stocks which we know will move a lot, and we can buy straddles, or we buy inverted condors or flies to profit from the market mispricing that, and we see big moves. Like we had snow last time, the average move was around 15%. It moved 35%. Imagine you had sold a straddle. It would have been like gone to the moon. But this is something which we don't leave to chance. So all of you which have started with MenthorQ, try to learn options, and this is an advanced course for options, but we always have to go back to the basics, and the basics are verticals and calendars. We will start with calendars in 2 weeks, where I will talk about calendars and how you can use them on earnings, and the magic of calendars and earnings with certain setups, and how you can use MenthorQ data to verify that, to set that up and harvest even more than with just simple spreads. But this is something we will do in another session, where we have to build calendars, explain how calendars work, why they're so hard to be calculated, why the IV crush is so hard to be calculated there. So you need good data, and MenthorQ has good data on your side. So which are the trades for this week I would definitely take a look at, and take a set NVIDIA, as long as I see that nothing bad happens, that the positionings in the skew don't change rapidly, and I get still something for, I get at least 1 to 5. This is at least the minimum I would do. If I go beyond that, I wouldn't do that. Another one I like, except Salesforce, is Home Depot. It is an average move of 3.5, and the implied is a bit higher. So if you find something which is about 5%, this is very nice. And we're going to take a look at this 1 second to see if we can build something for Home Depot. You should check the day of the release, but for the sake of it, we're going to open Home Depot here. This has been something I've been always making money in the last years by just playing the earnings. So give me a second. So what do we have here? We have an upper band here. And why do we have an upper band? Because this one breached really well. And you wouldn't be surprised if you would see Home Depot also dipping today. So how would we set this up? And this is nice that we see Home Depot before we close here, that I always try. Let's say I have 10 trades a week. I always try, because I'm a non-directional trader normally. I trade volatility and I trade setup. This is the things I do. Which means I trade time, which you don't have in earnings that much, only if things go worthless. I trade volatility. And the other thing I trade is the expected move, and I like balances. Because I'd like to trade non-directional, if I go directional, let's say I go on a positive trade with Salesforce, I will try to find a trade which has a bearish bias. Why is that? Because statistically, if we try to set ourselves on both sides, yes, if we are in a super bullish market, everything tends to go up, all chips seems to rise, but don't forget, earnings are different. Earnings, they are out of time and space most of the time. So if you find a bearish one, if you can have a bullish, that's super good. So if you risk, let's say 1K on the one side, then you risk 1K on the other side. Could you be wrong? Yes, but we know the model is right. A lot of times we look at the data, we just don't take trades blindly. And let's build ourselves here a bearish trade. So I'm going to see it was 400. So let's see if this is a trade we could and would take, if this makes sense. So sadly, we are not in, we don't talk here, so you listen to us, but would this be a trade that I would take? I don't know. Could be, but it's below, it says no slippage here. This is a trade I might not take, because we are below the 1 to 5 risk returns I take. So you see, I'm very strict with that. I'm very strict with that. Yes, if you see more dips like you have today, like let's go back and oh, sorry, let me stay here. We have another 1% dip. We could wait for the model tomorrow to show us some new data and see if it makes sense to go a bit lower. This would be a bigger and wider credit spread, but I think here we got some bad slippage here, 11%. So I would take that. Would this be something I would trade? Yes, if the model would show me that the break-even point is not 400, it's like 393 or 92 or something around there, and I would verify it with the data I showed you, yes, that would be a trade I would take. If I can take a trade with the same risk return on the other side. So if you want to keep it simple, try to find first liquid stocks. Secondly, you take the 5-day swing model and look where the break-even point is. If you want to enhance that, do two things. Look at the matrix, and on the other side, see how the stock moved right before the earnings date. And sometimes you can adjust a bit the break-even point. This is a very simple methodology. If you want to enhance that again, like I told you, try for every bearish trade, try to find a bullish trade. This is not always balanced. You will see my trades are not always balanced because we always trade in a bigger market. Home Depot will move on the day of the earnings, but it moves around with the market in other shifts. So sometimes I look at the sector outlooks. Things I use are like sentiment to see, let's say, if I have bearish trade and the sentiment's like super, super, super bullish. What is sentiment? The analyst, you can, but don't need to trust that much. The flow and other stuff, it just is like super bullish, and only the positioning is not that bullish, but not that bearish. It's somewhat balanced. I might take a second look at it and maybe either not take the trade or step away from it. So this is the things which can happen. And another thing which you can always do is, like I said, look at the matrix and see how the expectations over the next months evolve. So you get a feeling what the market thinks of the stock on the long run, where they try to factor in what the earnings report will bring to them. And what you can always do is monitor the changes in the options chain. And in the end, you have a very simple strategy which you can harvest on. But we're going to talk about more advanced strategies and build more advanced stuff, along on diagonals, and we want to keep our feet into the calendars and double calendars and all that stuff in order to even make more out of the data and the stuff we have. But in the end, I like the KISS principle. The aviator Kelly, who said about that, keep it stupid and simple. And this is the thing. If you have a strategy which is simple, or even stupid, because you can follow it even when you're tired, when you don't have time. And this is another thing. If you trade, yes, it's so exciting. You can spend all day, but we all have lives. We have other things. And that's why we have MenthorQ to make our lives easier. To give us the data which we need to sit down, maybe spend half an hour, 15 minutes, if you get used to it, to set up a trade. And if you want to have it easy, you put in some buy to close and buy stop orders, and you forget about it. And then the trades close automatically, and you don't even need to be there when the market opens because you have done your homework before. This is something I want to close off. Like, have a plan for when things go wrong. I have a plan also for when things go well, because sometimes things go well, we forget about them, and then plan things go dip or go to hell. Sorry for my expression, but have a plan and act according to the plan. And we have the data, there are the things, there are the support and other levels which and you've traded with MenthorQ for some time, the levels. Pull up a chart, put in your daily earnings trades and journal them and see it broke the put support, but it went back. This is something. Then I close for a break even. And in the end, if you close for a break even, and it's not a loss, you might have lost a couple of dollars for bid and ask, but it's not a big loss. You have managed well. And this is something we were going to teach you in the further classes, how to manage these things, because this is a more difficult part. At least this is what I found. Okay, Fabio, this is what I have for you. today, and I think we're coming to an end of our time, sadly.
Yeah, and I don't see any question, Dan. So maybe the comments is not working. I'm not sure, but I think this was great. And as Dan said, we're gonna have a new dashboard coming over the next few days. So stay tuned on our live here on YouTube. We're gonna update this. We're gonna also have another session with Dan next week about how to use the new data, new models. We're gonna have some new exciting stuff coming. Auto updated level on TradingView, quantitative strategies, new models. So there's gonna be a lot here. So stay tuned on our product launch. And then next week, we're also gonna have a lot of different sessions with our various traders. So we're gonna have future trading with Patrick and Anne-Marie from Top Step TV. We're gonna have a session with Tim on macro. With Doc, of course, we're going to look at zero DT options. We're going to have some session with Sherry and Patrick right here. We're going to talk about building quant strategies with Python. So that's going to be a new one next week. And then we're going to have a very big session with Ryan about trading volatility. So there's a lot of events next week, so stay tuned. And also we're going to have our new product release. So we're very excited about that. So again, thank you, Dan. Thank you, everyone, for joining. If you want to learn more about us, please join MenthorQ.com, and please create a free account so that you can stay ahead of our communication. You can join our newsletter, and then you'll get to know when the new stuff is available, and you can get access to all our use cases and backtesting results, but more to come for next week.
Thank you, Fabio, for this great session, and thanks everyone, and good luck. And
see you next week.
use the data wisely. See you next week. Bye-bye.